Have you ever wondered if your current investment strategy is the most suitable one for you? In the world of finance, investment strategy is the cornerstone of financial success. It's a game plan, a roadmap that guides your financial decisions, helping you navigate the complex and often unpredictable world of investments. There are many types of investment strategies, each with its own set of benefits, risks, and considerations. Some of you might be familiar with active investing, where you're hands-on, constantly buying and selling assets. Then there's passive investing, a strategy that involves less frequent trading and more patience. Or perhaps you've heard of growth investing, which focuses on companies that are expected to grow at an above-average rate. And let's not forget about value investing, the strategy that seeks out undervalued stocks in the market. Each strategy has its own unique appeal and suitability, depending on your financial goals, risk tolerance, and investment horizon. Stay tuned as we delve deeper into each of these strategies and find out which one could be the best fit for you. Firstly, let's consider the active investing strategy. Are you someone who likes to take charge and make decisions? If that sounds like you, then active investing might just be your cup of tea. Active investing is a hands-on approach. It involves continuous buying and selling of assets like stocks or bonds based on short-term market movements. The goal here is to outperform the market average. Think of it as a marathon where you're not just trying to finish, but you're aiming to outpace everyone else. This approach has potential for high returns, but it's not without its risks. It requires a significant amount of time and understanding of the market. You'll need to keep a close eye on market trends, economic indicators, and company performance. It's a bit like being a detective, always on the lookout for clues that can lead you to the next big investment opportunity. Active investing also comes with higher costs. Frequent trading means more transaction fees. Plus, you might need to hire a financial advisor or a fund manager, which adds to the expenses. However, if you're successful, the rewards can far outweigh the costs. So who's best suited for active investing? It's typically for those who have a deep interest in the financial market and don't mind dedicating time and resources to their investment. It's for the go-getters, the risk-takers, those who enjoy the thrill of chasing high returns. Remember though, active investing isn't for everyone. It's not meant for those who prefer to set it and forget it. It's not for those who'd rather avoid the roller coaster ride of market fluctuations. And it's certainly not for those who are not comfortable with the potential for loss. Active investing can be a rewarding strategy, but it requires commitment and knowledge. Determine if this is the right approach for you. If the active approach seems too time-consuming, perhaps the passive investing strategy might interest you. The passive investing strategy is like setting a course and sticking to it, letting the market's natural course take the wheel. It's a hands-off approach that focuses on long-term gains and minimal buying and selling. The idea here is not to beat the market, but to match it. You might wonder, how do we match the market? Well, this is achieved by investing in index funds or exchange-traded funds, more commonly known as ETFs. These funds track the performance of a specific market index like the S&P 500 and aim to replicate its returns. Now let's talk about the advantages of passive investing. The first, and perhaps the most appealing, is the lower cost. Unlike active investing, which requires paying hefty fees to financial managers, passive investing is a more cost-effective strategy due to its low expense ratios. The second advantage is the simplicity. You don't need to be a Wall Street whiz to understand passive investing. It's an ideal strategy for those who prefer to set it and forget it. The third advantage is its tax efficiency. Since passive investing involves less buying and selling, it results in fewer taxable events, which can be a significant benefit for investors. But like any strategy, passive investing has its disadvantages too. The most notable one is the lack of control. You're essentially tying your fortune to the market's performance, and when the market dips, so does your investment. Another disadvantage is the lack of flexibility. With passive investing, you're committed to your chosen index, and straying from that can disrupt the strategy. So who might passive investing suit best? It's perfect for those who don't have the time or inclination to monitor the markets regularly. It's also suitable for those who prefer a slow and steady approach to wealth accumulation. Passive investing is a long-term game. Consider whether this strategy aligns with your financial goals and investment temperament. Do you have a high risk tolerance and a long-term investment horizon? Then the growth investing strategy could be a good match. Let's dive into the fascinating world of growth investing. This strategy is for the bold and patient among us. It's about seeking out companies that are expected to grow at an above-average rate compared to other companies in the market. So, essentially, you're investing in future potential. It's a bit like planting a seed and waiting for the tree to grow. Now, growth investing can be highly rewarding, but it's not without its risks. The companies you invest in may not grow as expected, they might even fail. And because these companies often reinvest their earnings to fuel future growth, they're less likely to pay dividends. So your return is largely dependent on the increase in the company's stock price. But why would anyone take on such risk? Well, the potential returns can be substantial. If the company does well, the stock price can skyrocket, providing a significant return on your investment. Think about the early investors in companies like Amazon or Google. They took a chance on growth, and it paid off big time. However, it's not for everyone. Growth investing requires a high risk tolerance. You need to be comfortable with the fact that you could lose a significant portion, if not all, of your investment. It also requires a long-term investment horizon. You need to be patient and give the companies time to grow. So, is growth investing right for you? If you're the kind of person who likes to take risks, and you're patient enough to wait for potentially high returns, then it might be. But remember, it's always important to diversify your investments and not put all your eggs in one basket. Growth investing involves potential high returns and high risks. Assess if you're comfortable taking on this level of risk. Lastly, we have the value investing strategy. Are you a bargain hunter who likes to buy stocks when they are undervalued? If so, this approach might be right up your alley. Value investing is all about finding diamonds in the rough, those stocks that the market has overlooked or undervalued. Picture this. You're at a yard sale sifting through piles of items. Suddenly you spot a painting, dusty and unassuming, yet you recognize it as a masterpiece worth far more than its price tag. That's what value investing feels like. It's the thrill of discovering undervalued gems and waiting for the rest of the market to realize their true worth. Value investing is based on the principle of intrinsic value. This is the perceived value of a company's stock based on fundamental analysis rather than its current market price. The aim is to find stocks that are trading for less than their intrinsic value. Think about it like this. If a stock is selling for $20 but you believe it's worth $30, then it's undervalued. But remember, value investing isn't for everyone. It requires a good understanding of financial statements, patience to wait for the market to recognize the stock's true value, and the courage to go against the crowd. It can also be risky. There's always a chance that a stock is cheap for a reason and may never reach its perceived value. However, for those who are willing to put in the time and effort, value investing can be highly rewarding. Some of the world's most successful investors, like Warren Buffett, have made their fortunes following this strategy. It's a tried and tested method for long-term wealth creation. In essence, value investing is like a treasure hunt. You're looking for companies that have been overlooked by the market but have the potential to shine. It's about finding value where others see none and having the patience to wait for your investments to pay off. Value investing requires patience and a keen eye for undervalued stocks. Determine if this strategy matches your investment style. So we've explored 4 main investment strategies today. We started with active investing, where you, the investor, take a hands-on approach, making individual buy and sell decisions. Next, we delved into passive investing, a strategy that aims to copy the market index and sit back to enjoy long-term gains. Then, we moved on to growth investing, where you focus on companies that show above-average growth, even if the share price appears expensive in terms of metrics such as price-to-earnings ratios. And finally, we discussed value investing, a strategy where you're on the lookout for undervalued shares of companies and hold on to them until their worth is recognized by the market. Each strategy has its own merits and demerits, and what works best for you would depend on your unique circumstances. Remember, the best investment strategy is one that aligns with your financial goals, risk tolerance, and investment style. Make sure to conduct thorough research before making any investment decisions.